Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by my colleague, Egan from our Sovereigns Ratings team. We'll be covering the topic of the Shrewd debt management of European sovereigns as outlined in a recent research report, which can be found on our website. Following years of negative policy rate and unprecedented levels of quantitative easing from the European Central Bank, which pushed yields to record lows, Eurozone sovereigns are now facing an environment of sharply rising rates stemming from tighter policy. Successive external shocks, including the COVID-19 pandemic and the energy crisis driven by the Russia-Ukraine war, have left public debt elevated and fiscal deficits stretched. Ken, so as we emerge from a very low-rate environment, how has the past 10 years shaped the current sovereign borrowing picture?
Thanks, Gordon. Well, look, if we cast our minds back just over 10 years ago, many euro area economies faced a sovereign debt crisis in which borrowing costs on public debt shifted significantly higher, sharply raising the cost of issuance. Back then, the average annual interest cost of euro area sovereign debt stood at around 2.6% of GDP. By 2021, that figure had declined to 1.3% of GDP, even as outstanding public debt had sharply increased on average by about 10%. The main reason for the change was that in the following years after the debt crisis, the ECB's main policy rate, the deposit facility rate, was continuously cut into negative territory as inflation pressures failed to materialise. Years of negative interest rates, uninterrupted QE measures ensured downward pressure on yields, and during the Pandemic Emergency Purchase Programme forced borrowing rates to their lowest level on record. This period allowed euro area sovereigns to smooth their redemption profile and restructure their cost of debt. These trends changed after peak pandemic pressures subsided around mid-2021. High public intervention and subsequent investment, coupled with drawdown of savings and high global demand, prompted a dramatic increase in consumption. Inflation pressures built progressively throughout 2021, as did inflation expectations. This was partly due to surging demand and supply chain congestion, with rising food prices being a major contributor. Following Russia's invasion of Ukraine in February 2021, energy and food price increases accelerated, with the former being the overwhelming contributor to inflation through the year, pushing it sharply above the ECB's target level. In response, the central bank tightened policy. It hiked its deposit facility rate 250 basis points between July and December last year, while its QE programs were wound down and are now grinding to a halt. The sudden rise in the policy rate quickly led bond yield curves higher. Sovereigns suddenly faced a much higher cost of issuance than they had previously expected, while public borrowing is sustaining itself at an elevated level, partly because of the fiscal price shields for households and businesses.
Thanks, Ken. As you mentioned, borrowing has remained elevated for European sovereigns. How has this impacted on the levels of debt to GDP and their interest burden?
Yes, so as we know, borrowing is a pillar of government funding. Prudent debt management is important, as sustained higher interest costs can have a material impact on sovereign finances. While debt to GDP ratios are an important consideration, fiscal interest as a percentage of GDP is just as crucial. Public debt ratios have ballooned, but the interest burden weighing on government budgets in the euro area has fallen. Looking at interest as a percentage of GDP, the recent 4-year average clearly shows a stark decline in interest payments relative to the period following the European sovereign debt crisis and the beginning of the ECB's QE program. For 2023, interest as a percentage of GDP is expected to remain manageable despite ongoing policy rate increases.
You mentioned the policy rate increases, and European sovereigns are now facing a large change in their yield curves versus where they were in the recent past. How does this impact on the various sovereign issuers?
Yes, you're right. Euro area sovereigns have experienced a sizable increase in borrowing costs for their publicly issued debt over the last year. This is represented holistically by an upward shift in their yield curves over the last year. Rates for 5-year sovereign bonds have risen over 250 basis points and close to 200 basis points for the 30-year bonds, highlighting the pronounced shift of the entire curve. However, despite the persistent rise in yields driven by policy rate increases, the underlying average cost of interest on debt is not changing materially. Comparing current bond yield levels to the period of the sovereign debt crisis roughly 10 years ago, borrowing costs at key tenors remain markedly lower for many euro area sovereigns. For example, in Italy, Spain, France, and Portugal, the current 10, 20, 30-year debt is presently being issued at considerably lower rates. This is most clear when analysing Portugal, for example, where yields at key tenors are still more than 1,000 basis points lower than posted in the sovereign debt crisis era. Moreover, thanks to ECB policy support, the weighted average maturity of debt for many euro area sovereigns has increased, therefore minimising the impact of rising rates on the curve and indeed borrowing costs. Sovereigns took advantage of the big buyer in the market and the low rates to issue longer out the curve. For example, Ireland has lengthened its WAM from 5.8 years to 9 years. Similarly, France and Spain pushed the longevity of their curves. Spain from 6.2 to 8.6 years and France from 7.9 years to 11 years. Overall, this has afforded euro area sovereigns greater funding flexibility.
If we take a look at this on an average out basis, alongside some of the prudent moves that you mentioned have been made, where does this leave the sovereigns in the current situation?
So crucially, the average annual interest cost of debt has fallen in the euro area and is flatlining. For example, at 1.04% for Germany, it affords the government greater flexibility to ramp up other spending in the face of the energy shock. Similarly, France has rolled out considerable public spending to combat successive external shocks like the pandemic and the energy crisis, but the average interest cost of French debt has halved over the last 10 years. The move lower is even more pronounced among sovereigns that were in focus during the debt crisis era, like Italy and Portugal. We can see that their annual interest costs of debt declined from just below 4% around 2013 to as low as 1.5% in 2021. And these levels are currently hovering around 2%. For example, with Portugal, Portuguese cost of debt in the pre-pandemic period, 2015 to 2019, averaged 3%, while this year it is estimated to be 2.1%. Even in the event of another shock, euro area average interest costs are not widely expected to become overly burdensome or to approach euro area debt crisis levels. For example, according to Italy's Ministry of Finance estimates, a 1% increase in the Italian curve would prompt a 0.3% increase in the outstanding cost of debt after 3 years. While not a positive development, this analysis suggests that the impacts will be manageable thanks to the debt management initiatives taken.
As demonstrated by the UK last year, market dynamics in government bonds can be cruel. How are these supply and demand dynamics shaping up across Europe?
Yes, absolutely, Gordon. I think this is key to highlight. So KBRA also considers that average annual interest costs have the potential to increase at a steep pace over the medium term. Issuance and supply, buyers in the market, the anticipation of higher policy rates for longer are factors that could move the needle. Bonds providing collateral, for example, for TLTRO programs, will become unencumbered this year, while issuance for many euro area sovereigns and supranational entities is scheduled to rise. Notably, at the end of 2021, the German Finance Agency announced it would issue just over 400 billion for 2022. And in December of last year, it announced it would issue 539 billion for 2023. Similarly, in Italy, net cash borrowing requirement will rise from 60 billion last year to 90 billion this year. France will maintain its high level of medium and long-term net issuance for 2023 at 9.8%. The European Commission plans to issue 80 billion as well. So supply is robust. Meanwhile, the persistent and long-time buyer in the Eurozone market for the last 8 years, the ECB, will finally fully wind down its QE program and step out of the market. These supply and demand dynamics have the potential to create funding issues where liquidity could deteriorate, pushing issuance costs much higher than initially anticipated. I'd also just highlight, however, that yes, public debt remains elevated, but KBRA acknowledges it is consolidating at a faster pace than initially expected. So by the time the current high level of issuance feeds through to the overall average interest rate on outstanding debt, public debt will likely be much lower.
Many thanks, Ken. So, in conclusion, while public debt levels remain bloated and policy rates are rising at a fast pace, thanks to the low rate environment, the shrewd management of sovereign issuers, and high levels of QE in recent years, average annual interest costs for euro area sovereigns remain manageable and offer funding flexibility, which is especially important when considering the strain that government finances are under. As central banks continue to raise rates, these dynamics will continue to evolve, and we here at KBRA are actively monitoring the situation. Make sure you are registered on our website, kbra.com. You have access to or subscribe to our podcast, and of course, are engaged with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Stay strong out there as we navigate through this challenging environment.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at kbra.com. Lastly, please share any feedback or ideas for future podcast episodes by emailing us at media@kbra.com. We hope to see you next time.